Right now, silver is sitting around $77 an ounce. And what happens over the next 60 days could completely change the picture for investors. We are not talking about a small move to $80 or $90. We are talking about two completely different destinations. Either silver makes a powerful run toward $150 or it slides back toward $50. There isn't much middle ground left. And in this video, I'm going to walk you through exactly why. Not speculation, not hype, not social media optimism or fear, but real data, real market behavior, and the specific catalyst that could push prices sharply in either direction. Because right now, silver is standing at what traders call a major inflection point, a crossroads. And what happens next could either create massive opportunity or painful losses for anyone positioned incorrectly. So if you're involved in silver in any way, physical holdings, ETFs, futures, mining stocks, or even just watching the market, this is something you need to understand. I'm going to break down both possibilities in detail, the bullish scenario and the bearish scenario. Then we'll look at what current data actually suggests is more likely. No drama, no hype, just analysis. And here's why this moment matters so much. Just days ago, silver experienced one of the most violent price swings we've seen in years. Prices collapsed from around $121 down to $63 in just 4 trading days. That's nearly a 50% drop in less than a week. Then, almost immediately, buyers rushed back in. Silver bounced sharply, climbing back toward $86 before pulling back again and settling into the current zone between roughly $70 and $77. And now, the market is doing something important. It's pausing. Prices are compressing. Volatility is shrinking. Buyers and sellers are battling for control, and neither side has clearly won yet. When markets behave like this, they're often preparing for a major move. Think of it like a spring being compressed. The longer it coils, the stronger the eventual release. So the big question everyone is asking right now is simple. Does silver explode higher from here, or does it break down again? And here's the key point most people miss. This outcome is not random. Markets don't move purely on emotion. Underneath the daily noise, there are structural forces at work: supply, demand, currency flows, institutional positioning, industrial consumption, technical levels. And right now, those signals are telling a very clear story. Before we talk about price targets, we need to understand where silver stands technically and structurally today. As of early February 2026, silver is trading near $77, sitting right in the middle of a consolidation zone that formed after the violent drop and rebound. This zone is important because it shows where buyers and sellers agree on price, at least temporarily. Over the past week, one level has consistently attracted buyers, the $70 to $75 area. Every time prices dip into that zone, buying activity increases. Futures markets in both India and the United States show heavy volume there. Physical buyers step in. Industrial users secure supply. Large investors quietly accumulate positions. In other words, that zone has become support. On the other side, sellers have been active between roughly $85 and $95. Every time prices approach that region, traders start taking profits, momentum stalls, and prices pull back. So that zone acts as resistance. Put simply, the current battlefield looks like this. Silver is stuck between strong buyers near $70 and aggressive sellers near $95. And markets rarely stay trapped forever. Eventually, one side breaks. If silver pushes above $95 and holds there for a couple of days, it would signal that buyers are back in control, opening the door for another run higher. But if prices fall below $70 and fail to recover, the selling pressure could quickly accelerate again. 2 different breaks. 2 completely different futures. And in the next part, we're going to examine the bullish case, the scenario where silver launches toward new highs and potentially moves toward the $150 zone. Because whether you believe it or not, there is serious data supporting that possibility. Now let's walk through the scenario where silver doesn't collapse, but instead launches into its next major rally. And let me be clear, this is not wishful thinking. The bullish argument isn't built on hope or social media excitement. It's based on measurable trends already underway. Because if silver is going to make a run toward $100 to $150, something powerful has to push it there. And several forces are lining up at the same time. The first major driver is something most investors underestimate: industrial demand. Silver isn't just a precious metal sitting in vaults. It's one of the most important industrial materials in the modern economy, and demand from industry is accelerating faster than supply can keep up. Take solar energy as an example. Solar panels rely heavily on silver because of its unmatched electrical conductivity. Every new installation requires it. And global solar expansion is not slowing down, it's speeding up. Current projections show solar panel production consuming around 230 million ounces of silver this year alone, representing a massive share of global output. And installations continue growing every year as countries push toward renewable energy goals. China is expanding aggressively. India is building rapidly. Europe and the United States are racing to expand clean energy capacity. And every new solar farm consumes silver. Then there's the electric vehicle market. Modern EVs use silver in battery systems, power electronics, charging infrastructure, and onboard electronics. Industry forecasts suggest global EV production could reach 14 to 15 million vehicles this year, and each vehicle uses significant amounts of silver. And adoption isn't slowing. Governments worldwide continue pushing EV adoption through regulation and incentives. Add in 5G infrastructure, AI data centers, smart grids, and charging networks, all of which rely on silver for conductivity and reliability, and industrial consumption continues climbing. Put all of this together, and total industrial demand is approaching record levels, exceeding 1 billion ounces annually. And here's the crucial point: industrial users cannot easily substitute silver. It has unique properties. When manufacturers need it, they buy it, regardless of price fluctuations. That creates a demand floor under the market. Now let's look at the other side of the equation: supply. Global silver mine production sits around 900 million ounces per year. But here's the catch most investors don't realize: the majority of silver isn't mined directly. Roughly 70% of silver comes as a byproduct of mining other metals like copper, zinc, and lead. So miners aren't primarily looking for silver. They're producing it incidentally while chasing other metals. That means silver supply cannot quickly ramp up even if prices rise. Mines don't just flip a switch and produce more silver. And when production of base metals slows, silver output often declines as well. The result? For the past few years, global consumption has exceeded production, creating an ongoing supply deficit. Where does the missing metal come from? Recycling, government stockpile releases, and investment fund holdings fill the gap, but those sources are limited. You can't recycle endlessly, and stockpiles eventually run dry. Meanwhile, investment demand is returning. Exchange-traded funds that hold physical silver have started seeing inflows again rather than outflows, tightening supply further. So we now have rising demand and constrained supply happening at the same time. That combination historically pushes prices higher. Then there's the currency factor. Silver is priced globally in US dollars. When the dollar weakens, silver becomes cheaper for international buyers, encouraging more demand. And right now, the dollar faces long-term pressure due to persistent fiscal deficits and accommodative monetary policy expectations. If interest rates begin moving lower or markets anticipate easing policies, the dollar could weaken further. When that happens, precious metals usually benefit. A modest drop in the dollar can translate into a disproportionately large move in metals prices as global capital flows shift. Another important factor traders watch is the gold-to-silver ratio, which measures how many ounces of silver equal 1 ounce of gold. Currently, that ratio remains historically elevated. In strong precious metals bull markets, silver often outperforms gold, causing the ratio to compress. When that happens, silver prices can move sharply higher even if gold prices rise only moderately. History shows that when momentum builds in metals markets, silver tends to become the faster-moving asset. And finally, there's market positioning itself. Right now, many traders are still positioned defensively after the recent crash. But if silver breaks above the resistance zone near $90 to $95, those who bet against the metal may be forced to cover positions quickly. Short covering creates rapid buying pressure, often pushing prices higher in a very short time. Momentum traders then pile in, algorithms trigger, and price discovery accelerates. That's how markets move from consolidation to explosive rallies. So if several of these forces align, industrial demand stays strong, supply deficits continue, the dollar weakens, gold rises, and technical resistance breaks, silver could rapidly move toward triple-digit territory again. And some analysts believe that under favorable conditions, a move toward $130 or even $150 later this year isn't unrealistic. But markets don't move in straight lines. And in the next section, we need to look at the other side, the scenario where silver fails to hold support and drops back toward $50. Because ignoring risks is how investors lose money. Now let's flip the perspective. Because while the bullish case for silver is strong, responsible analysis means looking at the downside as well. Markets don't move based on hope, they react to conditions. And there are real risks that could send silver sharply lower again. So let's walk through the scenario where silver fails to hold support and instead slides back toward the $50 region. And this isn't fear-mongering, it's risk management. The first major risk comes from the US dollar and interest rate policy. Precious metals usually perform best when interest rates are falling or when investors expect easier monetary conditions. But if inflation remains stubborn and the Federal Reserve is forced to keep rates higher for longer, or even raise them again, the dollar could strengthen. A stronger dollar tends to pressure metals prices because silver becomes more expensive for international buyers. When that happens, global demand slows and investment money flows toward dollar assets instead. We've seen this before. When the dollar rallies sharply, silver often falls even faster because it's more volatile than gold. A moderate dollar surge could easily push silver back toward $60. A stronger rally could drag prices toward $50 or even slightly below, especially if momentum selling kicks in. The second risk is profit-taking and speculative unwinding. Remember, silver didn't slowly drift higher. It exploded upward in a very short period. Prices more than doubled in just a few months. And when markets rise that quickly, many traders are holding large profits. Eventually, they cash out. We already saw how violent that selling can be. One wave of liquidation sent silver crashing from above $120 down to the mid-60s in days. If prices struggle to move higher and traders become impatient, more selling could follow. Once key support levels break, stop-loss orders trigger automatically, forcing additional selling. Momentum flips, and suddenly everyone rushes for the exit at the same time. If silver falls below $70 and fails to recover quickly, technical selling pressure could accelerate. The next major support zones sit around $60 and then the mid-50s. Break those, and $50 becomes a realistic target. The third risk involves industrial demand slowing. Right now, expectations for demand remain strong, but global economic growth isn't guaranteed. If economic activity slows more than expected, manufacturing could weaken. Electronics production could slow. Electric vehicle sales could temporarily plateau. Solar installations could face delays due to financing or policy changes. China plays a huge role in global industrial demand, and if its economy slows further, commodity demand can weaken quickly. Europe faces energy and economic uncertainties, while emerging markets remain sensitive to currency and debt pressures. If industrial demand softens at the same time supply remains stable, the deficit supporting silver prices could shrink, removing a key bullish pillar. The fourth risk is purely technical. From a chart perspective, silver currently sits in a fragile position. Medium-term trends are not clearly bullish anymore after the crash. Key moving averages are being tested. If prices fall below important technical levels, especially the widely watched 50-day and 200-day moving averages, large institutional traders and algorithmic systems often reduce exposure automatically. When large funds sell, liquidity dries up and volatility increases. Retail investors panic. Selling feeds on itself. Technical analysts note that if silver cannot hold above the low 70s, downward momentum could quickly target $60, then $55, and possibly $50 if fear accelerates. And the final risk comes from history itself. In 2011, silver experienced a nearly identical pattern. Prices surged dramatically, driven by speculation and leverage, before collapsing nearly 50% in just a few months. After that crash, prices didn't recover quickly. Instead, silver traded sideways for years, frustrating investors who expected a rapid rebound. If the recent rally was driven more by speculation than long-term investment demand, history could repeat itself. Prices might stabilize somewhere between $60 and $70 and stay there for a long time before attempting new highs again. So let's summarize the bearish case. A stronger dollar and higher rates pressure metals. Traders lock in profits after huge gains. Industrial demand slows if economic growth weakens. Technical breakdown triggers algorithmic selling. And historical patterns warn that big rallies can unwind sharply. In this scenario, silver could realistically fall back into the $50 to $65 zone before finding strong support again. Which brings us to the most important question. Given both possibilities, what does the current data actually suggest? Is the bullish breakout more likely, or does the downside risk still dominate? In the next and final section, we'll look at the evidence, weigh both sides, and outline exactly what investors should watch next. So now we arrive at the real question. We've looked at both paths. The bullish case that could push silver toward $150 and the bearish scenario that could drag prices back to $50. But markets don't care about opinions. They respond to evidence. So what is the evidence telling us right now? Let's start with the most important signal, support levels. Over the past several trading sessions, silver has repeatedly tested the $70 to $75 range. And every time prices dip into that zone, buyers show up. Not retail panic buying, but steady, consistent accumulation. Industrial hedgers securing supply. Institutional money quietly building positions. If demand were weak, silver would already be trading in the mid-60s again. But it isn't. Support is holding. Second, industrial demand remains structural, not speculative. Solar expansion isn't a temporary trend. Electric vehicle adoption isn't reversing. Data center construction and infrastructure upgrades continue across the globe. Even if economic growth slows slightly, these long-term projects still require silver. Demand may fluctuate, but it doesn't disappear. Third, the supply situation hasn't changed. Production growth remains limited. New mines take years to develop. And because most silver is produced as a byproduct, supply cannot rapidly increase even if prices rise. The structural deficit continues, meaning inventories slowly tighten over time. Fourth, currency dynamics still favor hard assets over the long run. Yes, the dollar could strengthen temporarily, especially if markets fear inflation or tighter policy. But long-term fiscal pressures remain unresolved, and central banks globally are walking a narrow path between growth and inflation. Historically, that environment supports precious metals over time. Fifth, silver still looks relatively cheap compared to gold based on historical ratios. And when precious metals rallies mature, silver often becomes the faster-moving asset. Put all of that together, and current data leans slightly in favor of the bullish scenario. But, and this is critical, bullish does not mean risk-free. The bearish case still exists. And if certain levels fail, the outlook changes quickly. So here is the practical takeaway. Watch the $70 level carefully. If silver stays above it, continues consolidating, and eventually pushes above the 85 to 95 resistance zone with strong volume, momentum could carry prices toward 110, then 130, and possibly higher later this year. But if silver breaks below 70 and closes under 65, the bullish thesis weakens. Selling pressure could return, and protecting capital becomes the priority. In other words, the market itself will reveal the answer. You don't need to predict the future. You just need to watch the right levels and react when the market chooses direction. And remember something important. The biggest moves often happen when uncertainty is highest. Right now, silver sits exactly in that uncertainty zone. The next 60 days will likely determine whether this consolidation becomes the launchpad for another rally or the beginning of a deeper correction. Either way, preparation beats reaction. Stay disciplined. Watch support and resistance. Let price action confirm the story before making big decisions. Because markets reward patience far more often than impulse. Silver at $77. Two possible futures. The bullish case currently has the edge, but the bearish path remains real if key support fails. Now you know what to watch. And with that, you're ahead of most market participants heading into the next major move. I'll see you in the next update.